Hey everybody, welcome to the ANDIKA Bulletin for Thursday, 15th of December 2022. So here's the TLDR. The Fed hiked rates by 50 basis points as expected, but they did signal through its projections that it will hike rates higher than what the market expects, and they will hold those rates higher for longer. Furthermore, the projections for economic growth, employment and inflation all suggest the Fed does expect a recession. So keep in mind, just because of where we are today, it's still going to be a little bit rockier in 2023. Now, some of the quick throwaway statements that the chairman made were things along the lines that the labour market remains extremely tight. There's more, needs to be more evidence of lower inflation coming into the system. The Fed still has some ways to go on rate hikes. No rate cuts until the Fed is confident inflation is moving towards 2%, and the Fed will hold restrictive rates for a sustained time. So the market's been talking about for a while about a pause and then a pivot. Well, it seems the pause is going to be a real long one, and then down the track, there will be that pivot. Now, the market is pricing in rates being lower than the current rates by January 2024. In fact, the market's actually factoring in cuts of 6 cuts actually coming in. So that pivot will eventually happen, because obviously if the United States is in recession, then they're going to become very dovish, and they're going to want to turn the taps back on and take the foot off the interest rate pedal. But the market's not buying what the Fed is selling, and effectively the market's effectively today called the bluff on the Fed. I mean, the Dow was down 142 points, or 0.4%. S&P was down 0.6%, or just 24 points, and Nasdaq was down 85 points, down 0.76%. So it wasn't exactly a big bloodbath of a day by any stretch of any imagination. Now, the thing that people are just starting to look at is, what's the Fed going to really now do? So the market is now saying that the odds of a March hike of, say, just 25 points, not 50, has rose to about 60%. So they're basically saying in Feb, the odds of a 50 basis point hike are around about only 25%. So therefore, 75% chance they'll now be hiking rates at 25 point intervals, with March now being also 25 point intervals. And then the market's thinking that 76% chance that there'll be no more rate hikes come May, which is sort of a little bit earlier than what I anticipated. I thought myself that they'd probably stop hiking probably around about June, July. With regard to the RBA, I still think they're going to hike rates here in Australia by a quarter of a point in February, March, and in April. So in other words, another 75 basis points to come on top of what we've already got. That would take our cash rate to 3.85%. So that's where I think our guys will go, and then we'll also go into a sustained period of maintaining that rate, and probably also looking to cut, sometime in 2024 as well. Now, the couple of charts I'll just finish on, and this was a noticeable one. Powell was asked about the decoupling between financial conditions and the tightening of policy rates, and you can see the particular chart that I've got up here, where it illustrates the US Fed funds rate, as you can see, which is like a set of stairs, versus, the US Financial Conditions Index. And you can see where we've just had the Fed Open Market Committee meeting, and, we can see where the Fed's funds rate is now at, versus the fact that conditions have actually started to decouple away from that. So Powell's response was a bit of a but he finally admitted that it is important that financial conditions reflect policy restraint. And this is the quote: "The Fed's actually pretty hawkish here," said a former Federal Reserve of New York President Bill Dudley. He also draws attention to the comment from Powell that the start about the need for financial conditions to reflect Fed tightening action. And this is the quote: "If markets ease financial conditions, the implicit notion there was just then means we're going to have to do more to make financial conditions tight." So the question really comes here is, so what do you think that means for call spreads, stock prices and bond yields? They're going down. And just to finish up, here's my favourite chart. Nothing's really changed from this at all. We still see where the S&P 500 is of today and how it's tracking against the S&P 500 of 2008 and 2009. Obviously, we need a few more days and weeks for this to run out and see how it goes. But the market now knows where the Fed's position is. They're making their bets on what their positioning will be starting in February. And it's now a game of brinksmanship on what happens there. And I dare say any rhetoric coming from the Fed that continues to maintain a hawkish tone will be the thing that drives markets to head south and that sort of thing. And then naturally, as economic data starts to come out, that starts to show that the United States is coming itself into a recession, will then start to take, forefront on where people are going to want to direct themselves. Anyway, it's a bit of a long-winded report this morning, over 6 minutes, so I'll finish up there. So happy Thursday, take it easy, and we'll catch you next week. See you later.